I'm David Edelman from Morgan Stanley, and welcome to Pushing on Parker, a discussion and dialogue with Adam Parker, our Chief U.S. Equity Strategist. Adam, we're about half through second quarter earnings. What are the key takeaways so far?
You know, what we've seen the last couple of years, really, David, upside to earnings, more upside to earnings than revenues, about 5% upside to earnings, 1% to revenues, which means concerns about wage pressure were overblown, not really seeing it, which means concerns about margin peaking are overblown, given how could you have that much upside to earnings with that little upside to revenue. I think other trends, capital spending, still really not picking up in tech and industrials, and loan growth positive, but maybe less than what consensus was hoping for, a bit mixed bag there.
What's the structural dynamic, if there is one or two, that's resulting in operating margin leverage across corporate America? Is it sort of the inherent leveraging of fixed costs? Is it lower interest expense because of lower rates? What's happening at a macro level?
There's a number of factors. You hit on a couple of them. I'd say, look, number one way you get higher margins is through pricing power, right? If you can have rising utilization without CapEx, that's a win. I think if I'm right, we don't get a big capital spending pickup. Not great for the GDP numbers, but makes corporate profitability hold in better. I think labor productivity is another key feature, and you're just not seeing companies talk about wage pressure broadly across the market. And you're still seeing them focus more on productivity than on PP&E or people. And then I think the wild cards after that would be currency and commodities, and you just haven't seen huge volatility there, and the volatility is usually what makes companies miss.
One theme from 2013 was the S&P generated superior returns because you had significant expansion in valuation, the market multiple.
Right.
Well, what could drive the downside risk over the midterm? What's the scenario where we see significant valuation contraction?
Look, as you know, a couple weeks ago in our second half of the year preview, we kind of said, okay, we're not really bullish anymore as much as we are a little bit more balanced. We tried to articulate why we're balanced. I still think that the probability of a recession in earnings is low, and if you get that growing, that's going to be the number one way you could have a double-digit market correction. Our view is you won't have a 10% or larger correction really ever without people being afraid of an earnings recession. I think there's two possibilities, what I call macro-micro reasons and macro-macro reasons. The macro-micro would be CapEx, hiring, inventory. You put costs in place that turn out not to be merited. I don't think that's very likely because we're just not seeing that in the market. So I think they have to be macro-macro reasons. They have to be the tapering. And as that unwinds in September, October, it creates a little bit more of a urgency around any bad economic data if it does form. Geopolitical risk, and certainly the world's a risky place right now. It could be around regulation, and as you see into the midterm election, typically there's a focus on regulatory environment. So I think it's got to be more macro right now because I just don't see enough costs being put in place from the companies.
Is it incongruous that we're at the same time seeing an M&A renaissance, and yet small cap stocks have been lagging the market?
Yes, it is. I think the M&A renaissance is fueled, though, by the fact that it's probably, for the first time in our investment lifetimes, safer than CapEx. It's immediately accretive. It doesn't come with some of the risks of adding capacity. And there's a tax inversion element, which typically wasn't the case in the past for a lot of deals. And I think, the case for small caps, and we're recommending small caps, is I think there's more margin expansion potential. I think they grow faster, and I think M&A typically fuels them, and that offsets the valuation discrepancy right now.
Two other questions, Adam. One is, can you talk a bit about, from a sector perspective, your biggest overweights in healthcare, your biggest underweights in consumer staples? Arguably, those business models aren't that much different than each other. The scale of the companies, the number of firms, the global positioning, the free cash generation. It's been a very good call, but why does that continue to work, and what's the underlying pillar of that differentiated view?
I think it's a great question. I think 2 years ago we felt very bullish on healthcare, R&D pipeline re-rating, and kind of the beneficiaries of more volume through the system seem to be there. I think now I just still feel a little bit more negative on staples. When we use our quantamental process, I see very little opportunity. The big cap companies are missing and they're expensive. So we're focused more on pharma and medical distribution and more cautious on most of the staples. I just think you need better estimate achievability out of the staples to get more optimistic there.
And then lastly, something that most people might not know that you and I have in common is? We're both married to Badgers.
That's true. We both married to Badgers. By the way, nice tie today. I'll point that out. It happens to be my tie. Any questions, please don't hesitate to contact us.
Thank you.